Welcome to section 2.4 of the foreclosure prevention class, types of mortgages. Oops. Let's talk about the different types of mortgages there are out there. There are fixed rate mortgages, there are adjustable rate mortgages, balloon mortgages, interest-only mortgages, and pay option ARM mortgages. The first one, fixed rate mortgages. What is that? Fixed rate just means that the interest rate will not change for the life of the loan. Does that mean the payment will change or won't change? Doesn't affect that at all. The payment can absolutely change because the taxes, the real estate taxes being paid can change, the homeowner's insurance policy can go up year after year, but the interest rate will not change. So that means it's fixed based on the interest rate. The principal and interest portion will not change. That's all fixed rate mortgage means. Now, adjustable rate mortgage, some key points to remember here is that the initial rate may be temptingly low, but not likely to stay low. The borrower may take advantage of decreasing interest rates if rates decline, which many did after the mortgage meltdown. Pardon me. A borrower may be prepared to continue making payments when the rate increases. So there are certain instances where an adjustable rate mortgage might make sense. For instance, if you have a client who's an airline pilot, most airline pilots the first couple of years make average amount of money. Depending on where you live, it varies, but it's low typically for an airline pilot for the first couple of years because they've got to earn a certain amount of miles flying. By year 3, their pay jumps. I want to say it doubled or tripled. It's some huge jump. So then if you've got them in an adjustable rate mortgage, it's low for the first couple years so they can keep their payment low, and then when their income jumps, they'll be able to afford the rate as it adjusts up. So that may be an option. The rate varies on a predetermined schedule with an adjustable rate, so it doesn't just randomly go up. It's going to be set. When does it adjust? Well, it depends on what type of adjustable rate mortgage it is. With an FHA mortgage, it can adjust more than once a year. On a conventional mortgage, it can adjust once every 6 months. But it's going to just depend on the type of mortgage. You want to make sure that your pre-purchase clients that you're educating them if they're wanting to get into an adjustable rate mortgage. Now, what is the rate based on? It's going to be either the Treasury bill rate or the London Interbank Offered Rate, or we call it the LIBOR. And if you go to bankrate.com and just put in LIBOR, you'll see what that rate is. And it adjusts daily, but minimally, but you can kind of see where it is. And then there's going to be a margin added to that, and the bank's going to add that margin. And they'll let you know, this is the margin, this is the index, this is what determines the rate. What are the caps? That's a question you want to know. Like, what's the maximum can that rate go to? What will the payment be at that maximum? And what's the maximum it can go to per change versus over the lifetime of the loan? So that's going to be important. You want to make sure if it does max out, like with FHA, 5% over the start rate, that your client will be able to afford that payment. Very important information to know. Now we have balloon mortgages, and this is where the principal must be paid in full at the end of the term of the loan, which is usually 5, 7, or 10 years. This usually offers a lower interest rate similar to the adjustable rate mortgage. If the borrower decides to stay in the home past the term of the mortgage, then the balloon must be refinanced or paid in full when the mortgage becomes due. And this seems like a good idea. Again, let's use my example of the airline pilot. They know their income is going to double in 2 or 3 years, so they get into a balloon mortgage, which makes sense at the time because it keeps their payment low for 5 years. They can refinance and get into a fixed rate when they're making more money. This is all fine and well, except what if the pilot loses their job? And then they can't make the payment. Or they get another job where they're not a pilot anymore, and so they're making a set amount, and their income's not going to jump like they thought it would. So these are just things you want to make sure that if they're looking at, if they've gotten into one of these loans, that they understand what it is and that you understand how it works. Interest-only mortgages. Typically, an interest-only mortgage is a 30-year term, and during a predetermined period of time, the borrower only pays the interest. The payment will likely increase as you begin to pay both principal and interest. The actual loan will be more costly over the life of the loan as the principal is not being paid during the initial interest-only term. So with an interest-only, let's say if you've got a 3-year interest-only, then the first 3 years, they're only paying interest. The next 27 years, they're paying principal and interest. Well, that payment on the principal and interest is going to be higher than if they paid principal and interest the whole term because it's amortized over 27 years instead of 30. And then think of it this way. They didn't make any principal payment the first 3 years, so they still owe the full amount of that loan at year 4 after the first 3 years. So something to think about. And there were also interest-only terms that were interest-only for 5 years, even 10 years. So it's interesting to be in a home for 10 years and owe the same amount you did when you first moved in. But this was a very niche product. This was for people who bought homes in areas where the appreciation was high. And so, and I'll give you an example. I have a friend of mine who bought a condo in California, and at the time she bought her condo, I think she paid $90,000 for it. At the top of the market, it was worth 240, I think. So had she sold then, it wouldn't have mattered if she still owed the 90 because it had appreciated so much that she would have still done really well. And so that's why I think a lot of people got into interest-only mortgages, especially investors. It was a good product to use to maximize the cash flow. But for first-time home buyers, just not something that makes a lot of sense. Next, we have the pay it option arm, and this was, people also call it a pick a payment loan. The borrowers were given an option of how much to pay each month. The minimum payment, though, did not even cover the accrued interest. So you could do an interest-only payment, or you could do this payment that was like at a teaser rate, which was really low. And what ended up happening is if you chose the lowest payment, then you ended up owing more than you originally borrowed because it wasn't covering the full amount of interest. And that's what we call negative amortization. So we saw quite a bit of that. But you could choose that really low payment, you could choose the interest-only payment, you could choose a fully amortizing 15-year payment or a fully amortizing 30-year payment. But like I said, this was a very dangerous program because when it was, again, this was another niche product that was really, I think, designed for people who were maximizing their cash flow initially, who may have their income was cyclical. So maybe there was a part of the year where they were making more money and they could make the full amortizing payment, and then part of the year where they made less, where they needed to make just the minimum payment. But what was happening is a lot of people, a lot of first-time home buyers got put into this program, and they just made the minimum payment. And then the market did what it did, property values fell, and people not only owed, more than they owed originally, but the house isn't even worth it. So it just got ugly. So we don't see pay option arms much anymore. I don't know if they're completely gone. I'll have to check into that, but I definitely don't see them much anymore. Stated income, stated asset, this went away. This I do know, went away with Dodd-Frank. Borrowers state their income or their assets without providing verification. And basically what this meant is, as a lender, we didn't even ask how much you make or how much money you have. It was just sign your name, what's your social security number. Interest rates were typically higher with this, of course, because it was considered higher risk. And it was really designed for high wealth people and self-employed borrowers. Because self-employed people write off a lot of expenses, but their net income shows really low on their tax returns, and that's what we were required to have to use to qualify them. So, and it goes for high wealth people who just didn't want to disclose how much money they made. But again, it just like the pay option arms and the balloon mortgages were sold to first-time homebuyers who really just did not have the lending savvy to be able to handle these types of mortgages, and it just became a crisis. as we saw. Exotic loan risks. They were not, and these are what we were just talking about, not created for long-term sustainability. These were short-term. These are supposed to be short-term mortgages. People are supposed to refinance out of them after a period of time. Property is located in a declining market. That's another risk. Income is not guaranteed to be sustained or increased. Home prices remain flat. That's definitely a risk. And then what if the homeowner is near retirement and not likely to continue owning the home for more than 10 years? So that these are all risks of exotic loans. Suitability. Not all loans presented are suitable or sustainable for low to moderate income homeowners or unsophisticated borrowers. And they should not. Really, they should not have been sold to this type of borrower, but they were. These products can be appropriate for different types of buyers, such as investors, developers, high net worth borrowers, savvy, sophisticated borrowers, people who feel comfortable with finance. And that's not everybody, and that's okay. But unfortunately, that's not what happened. Well, that's the end of section 2.4. We're done.